Hi, this is Elliot Eisenberg, consulting economist to American Pacific Mortgage, catching you up to date on the latest in economics. And what I want to talk about is interest rates. We have been on a crazy ride. From the end of December until now, we've seen a rise in interest rates that we have last seen at least 40 years ago. You've got to be almost 60 years old to remember. Why? Up until the end of last year, the expectation was that the Fed would raise rates once or twice, maybe 3 times, 25 basis points each time, because they thought inflation was transitory. And then suddenly, around the end of the year, the Fed changed their tune, and Powell literally pivoted and changed his mind and said that their belief that inflation was transitory was, well, transitory. And then the rate increases, the announcements about what they were going to do began to go hot and heavy. And now the expectation is the Fed's not going to raise rates a couple times. They're going to raise rates possibly 200 basis points, 2 percentage points, maybe as many as 3. And we don't know. Maybe it's more. Who knows? This uncertainty is weighing on markets and raising rates. 10-year treasuries, the Fed funds, and it raises 30-year mortgages as well. The other thing that's going on is there's a tremendous amount of uncertainty. We don't know how high the rates will go. We don't know when the rates will peak. We don't know how long they'll stay up. We don't know when they'll come down. We don't know how long the war in Europe will last, how bad the lockdowns in China will be, and so on. That causes investors to want a higher rate of return because the uncertainty around things is heightened. We see this because historically the relationship between the 10-year treasury and the 30-year mortgage is 175 basis points or 1.75 percentage points. But right now we know the 10-year treasury is roughly 2.8. That would suggest that a 30-year mortgage is 4.6. But it's not. It's closer to 5.2. That difference of 60 basis points or 0.6 of 1 percentage point is because investors are saying, oh, rates are going to go higher. We don't know how long and for how long and what the story will be and how it will come down. We want more money. On top of that, there are 2 more things driving rates up. The first, the US dollar's gotten much stronger. As a result, hedging it for foreigners who want their currency held in euros or yen or pounds, to hedge against currency changes is more expensive. So foreigners are saying, maybe I'll buy less US treasuries and mortgage-backed securities, raising the rates on both of them. And last but not least, the Fed is about to start quantitative tightening, the exact opposite of quantitative easing. As a result, the Fed's likely to reduce, not increase, but reduce their holdings of mortgage-backed securities and treasuries as well, by the mortgage-backed securities by roughly 30 to 35 billion a month starting soon. That's also going to put pressure because there'll be less demand for all kinds, both treasuries and MBS, pushing rates up. So if you add it up, you've got quantitative tightening, you've got a US dollar strengthening, you've got uncertainty and the pivot by Powell. And as a result, rates are substantially higher than they were. I hope this gives you an explanation for what's going on, and I look forward to seeing you next month.